Have you ever seen someone make money in the stock market and thought, wow, that was way above normal? That idea, earning more than what's expected, is exactly what we call abnormal returns. Abnormal returns simply mean the extra profit an investment makes compared to what was expected or considered normal. It's not just about making money, it's about making more than you should have given the level of risk you took. To understand this properly, we need to look at what normal return means. In finance, every investment has an expected return. This is based on things like market performance, risk levels, and historical data. For example, if the overall stock market is expected to return around 7% a year, that becomes a kind of benchmark. Now, if you invest in a stock and it returns 7%, that's normal. But if that same stock suddenly returns 15%, then the extra 8% is considered abnormal return. Let's make this even simpler. Imagine you invest £1,000 in a company. Based on market conditions, you expect to make £70 in a year. That's your normal return. But instead, you end up making £150. That extra £80, that's your abnormal return.
So, why do abnormal returns happen? One major reason is new information. For example, if a company suddenly announces higher profits than expected, its stock price might jump quickly. Investors who bought shares before that news was released can earn abnormal returns. Another reason could be market inefficiencies. In theory, markets are supposed to reflect all available information instantly, but in reality, that doesn't always happen. Sometimes prices are slow to adjust, and that creates opportunities for investors to gain an edge. There's also skill involved. Some investors, like hedge fund managers or experienced traders, aim to consistently generate abnormal returns by analyzing data better or acting faster than others. But here's the catch: abnormal returns are not easy to achieve consistently. In fact, according to a concept called the efficient market hypothesis, it's extremely difficult to beat the market over time because prices already reflect all known information. This leads to a common misunderstanding. People often think high returns always mean skill, but sometimes abnormal returns can simply be luck. A single successful trade doesn't necessarily mean someone has a long term advantage. Another important point is risk. Sometimes what looks like an abnormal return is actually just a reward for taking higher risk. So, in finance, returns are always evaluated alongside the level of risk involved. So, what's the key takeaway? Abnormal returns are the extra profits you earn above what's expected based on the market or the level of risk. They often come from new information, timing, or sometimes skill, but they can also be due to luck and they are very hard to achieve consistently. And once you understand abnormal returns, you start to see the difference between simply making money and truly outperforming the market.